Savings is one of the greatest ways to build wealth and sustain yourself over the long run. However, in recent times, it's been extremely difficult to save and probably to build wealth simply because of the impact of inflation. So don't get me wrong, let me explain. Inflation is simply the general rise in the prices of goods and services in an economy over some time. So simply put, it is the rate at which the prices of goods and services that we consume on a daily basis, for example, the food that we buy, the groceries that we shop for, the clothes that we buy, it is the rate at which all these things increase in prices over a stipulated time period. So savings alone might not necessarily make you rich, and the reason is simple. Currently, the inflation rate in the US is 2.4% and then 2.6% in the UK as at the time that I was recording this video. And then the average savings interest rate for putting your money in the bank in the US is around about 0.4% and then 2.45% in the UK, which simply means that holding all other factors constant, for every £10,000 that you put in a bank, you lose £150 at the end of the year. And then for every $10,000 that you put in a US bank, you lose $200 on average every single year. So instead of building wealth through savings, currently you're rather losing money putting money in your banks. So what can you do at this point? Now hang on, in a minute I would explain what you can do in order to secure your finances and then build wealth in the long run. So this brings up the question, how can we protect our finances and our savings against the impact of inflation? Now this is simple, and you can do that through a high yield savings account. Now that simply means that you have to put money into a savings account that returns interest that can offset the impact or the damage that inflation is likely to do to your finances or to your savings over the long run. And so simply the only way you can help yourself or to empower yourself in order to reach your goal in the near future is to invest in a high yielding savings account. So simply, what is a high yield savings account? A high yield savings account is a savings account that returns more interest than the average or the traditional savings accounts that we know. So for example, if you're to walk into a bank in the US or in the UK and you tell them that you want to save with them, the only interest that you would accrue on that savings in the US is 0.41% at the end of the year, and in the UK it is 2.45%, like I've stated earlier. So for every £1,000 that you put into the bank would give you £25 at the end of the year. And in the US, the banks will give you $4.5 at the end of the year. And that is extremely minute. These amounts would not actually make you financially free or take you a step towards the attainment of your financial goals. And so high yield savings accounts actually promise anywhere between 4.5 and then 4.6% of interest at the end of the year. So instead of going for the traditional savings account, which promises 2.5% in the UK and then 0.41% on average in the US, you actually opt for the highest, which is 4.6%, which can only be achieved through the high yield savings account. This brings us to the next question, which is, how do high yield savings accounts actually work? So it works simply like the traditional savings account that we all know. So you make your deposit, and then the deposit actually attracts the 4.5 or 4.6% interest at the end of the year, and then you can actually withdraw. However, there are some online banks and then some credit unions that place limits on your withdrawals and your deposits. So those are the things that we are likely to consider in this video in order to help you to make the best decision when choosing a HYSA, and how you can actually go on to optimize and then get the best of returns in order to build wealth. This brings us to the next question, which is, how are HYSAs actually different from the traditional savings account? So they are not any different. However, the only difference is in the interest that you earn on your savings. So simply, on average, the savings account interest on an average or the normal traditional savings account is 0.46%, according to the Federal Deposit Insurance Corporation in the US, which is the FDIC. The average earnings on a traditional savings account is 0.46%. However, for HYSAs, it varies from 4.5% to 4.6%, which is nearly times 10 of what the traditional banks are promising you. And for the avoidance of doubt, the FDIC, or the Federal Deposit Insurance Corporation, is responsible for protecting your savings. And that brings us to the next question, which is, are HYSAs actually safe for me to put money in there. Because sometimes when you talk about the interest rate that you're likely going to accrue from a HYSA, people think it is as a scam or a scheme that is meant to deprive them or to rip them off of what they've actually worked so hard to achieve, and that is their savings. Now, the FDIC is in charge of one thing. They protect you or your savings, your deposit, and sometimes even your insurance investment against the case of a bank actually defaulting, or in the case of a systemic banking crisis or an economic turmoil like we saw in 2008 and 2009. They come in to ensure and to make sure that your deposit is secured up to the tune of $250,000. So what that simply means is that even if these banks are to collapse, the FDIC is there to ensure that you get your money up to the tune of $250,000 at the end of the year. In the UK, the FSCS is also responsible for that. So they also ensure that your deposit in the form of any HYSA or any investment in a bank is actually protected, which means that in the case of a default on the side of the bank, or in the case where you're likely to lose your money, they would go on and then act in your interest. In the UK, the sum insured, or the sum that you're likely to receive when the bank goes default, according to the FSCS, is £85,000. If it is a joint account, then the amount is doubled. It moves straight away from £85,000 to £170,000. So don't worry about HYSAs, because most of them are actually protected by the FSCS in the case of the UK, and then the FDIC, which is the case for the US investors. And this brings us to the next question, which is, how do we use HYSAs? Now, you can use your HYSA to build an emergency fund, or you can save for a short-term or a long-term investment. Probably you can even use it as a supplement for your pension. So as opposed to you just contributing into a 401k or a Roth IRA, you can actually go on also to have these high-yielding interest accounts also supplementing your pension, so that at the end of the day, when you retire or you go on pension altogether, you wouldn't be cash strapped, because these investments will also be accruing and your savings will be attracting the 4.6% annual interest, and then that would also cushion you financially when you finally retire. So this brings us to the next consideration that we have to make in order to be certain whether or not we are putting money into our HYSAs, and that is the pros and cons of having a HYSA or putting or investing money in your HYSA. So the first thing we consider is the pros. The pros is that there are no fees, and you can actually access those savings anytime that you want. And of course, you also take advantage of the 4.6% promised interest at the end of the year, which is nearly times 10 of what the traditional banks are actually promising. However, on the other hand, we can have the cons. The con is that, sometimes most of these banks or most of these credit unions that are actually offering these HYSAs are online banks, in that they are not, banks that like the traditional ones that we know that we can walk into, or with several branches nationwide that we can go there to interact or to seek clarity on several issues. They are not like traditional banks. They are not physical banks. Most of them are online banks that are surely also regulated by the FDIC and FSCS in the case of the UK. Also, most HYSAs actually have withdrawal limits. So they can actually put some conditions in the terms when you go on to save with them, in that maybe, for example, you may have to notify them maybe 5 working days before you make withdrawals, or you cannot make withdrawals prior to maybe reaching a certain threshold of investment or saving in their account. So these are the nitty-gritties and the things that usually just actually make people not to get any interest in HYSAs. However, the pros actually outweigh the cons. So it is a great way for you to actually save money and to subsequently pursue your financial goals at the end of the year. And so this brings us to the last point, which is, how do we actually put money into HYSAs? Now, the first thing that I would advise is that you call your banks. Because, for example, sometimes there are banks that can actually offer you high yielding interest on several savings that, or probably they have some products that you can take advantage of. And once you're already an existing customer with them, it is much more easier for you to move funds without attracting any fees. So that is one of the most effective and the efficient ways that you can actually go on to save in a HYSA. Secondly, you can go on several online platforms, for example, like Raisin. Raisin actually helps you to to compare the rates amongst banks and to know what terms and conditions might be favorable to you, because every one of us has got a very unique way and a very unique appeal and a very unique goal when it comes to finances. And so it is much more easier for you to assess these banks, read, and their documents are not that, cumbersome or too difficult for you to understand. Of course, I'll project a couple of them with the terms and the conditions on the screen to make it much more easier for you. They explain the terms, that is the interest that you're likely to accrue at the end of the year. They go on to also explain the compounding, that is the amount of times that they're likely to pay you interest over a stipulated time period, that is within the 12-month period. And then they also go on to let you know whether there are limitations that when it comes to withdrawals or deposits. So it's much more easier for anyone at all to actually read these terms and conditions and understand. At this point, if this video actually serves some value or purpose to you, I would humbly plead with you to hit the like button or probably subscribe, because I'll be shooting several videos explaining several concepts on insurance, on savings, on sales, on economy, to actually help you to make informed decisions and to steer you towards the attainment of your financial goals. Thank you for spending time with us, and see you in the next video.